Welcome to episode 4 of Finance for Startups. We're going to talk about balance sheet today. Today, we're going to take it a bit light, no complex math. We'll try to understand the underlying concepts. So, what exactly is a balance sheet? It's a snapshot document at a point in time, usually on 31st March of every financial year. It tells about the assets and liabilities of the company. A balance sheet has two sides. One is an asset side and one is the liability side. And it should balance, as the name says. Your asset side should match with your liability side. Before we go into the details, let's understand the fundamental concept. What exactly is equity? When you start a business, when you or a group of people start a business, the founders or the owners infuse funds into the company for the running. They may do it once, they may do it multiple times. The expectation is once they infuse the fund, the revenue from the company should be able to sustain it. You invest your money, you start a business, you run your entire business for a year. At the end of the year, the company makes profits. The expectation is out of the profits, the company keeps some portion for future growth and pays the rest as dividend to the owners. So this is the most simplified idea. Now, depending on where you stand, you may choose to give dividend, you may choose to give more money in the company for future expansion. That all depends on where you stand and what you plan to do in the future. One thing you have to keep in mind is an owner of the company or the owners, shareholders of the company, and the company are different legal entities. When an owner infuses money into the company has a liability to the owner to pay it back. It's not supposed to give that money perpetually. At some point of time, it has to be returned. This is the fundamental reason why equity is considered as a liability, something the company is using right now, and something the company is supposed to return late. Now, let's look at a very simple structure of a balance sheet. So, as I said, it has two sides. On the left side, you have assets of the company. And on the right side, you have liabilities of the company. Okay. On the asset side, you typically have items like cash, your plant, property, and equipment. So you basically your machinery, buildings, etc. You have your cash equivalents, that is your account receivables. Account receivable is, let's say you raised an invoice, you haven't got the payment yet, it's your account receivable. So stuff like this. On the liability side, you have your loans. If you have loans from the bank, you have your account payables. Account payable is, let's say, you have an invoice in hand which you haven't paid it, that goes on your account payable side. So when you add up all the items on the asset side, and when you add up all the items on the liability side, it should match. That's the underlying concept of balance sheet. Now, earlier we talked about equity. That equity should come on the liability side of your balance sheet. So after all the liabilities, you have something called equity. Okay. Equity is the money the company has taken as a liability, as a debt from the owner. So there are multiple components. The first thing is the equity itself, your amount that is coming from the cap table. Now imagine a scenario that you run the business for a year, you have a profit, but instead of paying the owners back in as dividends, you decide to keep it within the company for future growth or whatever is the reason, and you do it year after year. So the money from your final profit that you're not paying back, which is retained in the company, is called retained equity. Sorry, retained earnings. It is also called other equity. So what happens is, imagine a company that is not paying dividends to the shareholders periodically. It is accumulating that cash within the company. So it will accumulate cash here on the asset side, and the corresponding entry will come here on the liability side. So the asset increases, so the liability also increases. Now, the fundamental balancing equation is assets equal to liability plus equity. This should always match. Equity includes other equity also. So this is the golden rule which should always match. A extension of this concept is if you take assets minus liability, you get what is called as book value of the company. You may have came across this term if you are an equity investor. If you're investing in the markets, you may hear terms like, hey, this company is trading under its book value, so it's a good buy. So what they are saying there is, you have the book value of the company, you have the total number of shares of the company. If you divide book value by total number of shares, you get book value per share. And if the current price of the share is less than that, people consider that company to be undervalued. Or in other words, you're saying this company is inherently worth more than what is reflecting in the share price. When it comes to assets and liabilities, you have to understand two more concepts. One is called current, the other is called non-current. This applies to assets as well as there are current assets, there are current liabilities, there are non-current assets and non-current liabilities. In simple terms, a current asset or a current liability is something that you have to pay back within in the financial year within 1 year, and a non-current is something that you have to pay back over a longer period. A very simple example would be an invoice that you have to pay within 90 days is your current liability. A long-term loan that you're taking from a bank, let's say for 5 years, it's your non-current liability. But of that loan, you may have to pay back some portion this year. So that comes into the current liability part. The rest remains in non-current liability part. So I hope this was good for you. Before we wind up, I'm going to ask a very simple question. You are a SaaS company, you're giving, let's say, CRM or some sort of software solution to your customers. You're running a marketing campaign where you say, hey, if you pay for 2 years, I'm going to serve you for 3 years, basically buy two, get one free. And if you pay for 3 years, I'm going to give you service for 5 years. All right. So your marketing campaign becomes an instant hit. A lot of companies sign up because they know your product is good and they're getting a good discount on the price. So a lot of people signed up. So let's say most of them signed up for a 3 year plan. They pay for 3 years and you're serving them for 5 years. How do you do the accounting treatment of this transaction? I mean, if you get advance payment, how do you treat it? I mean, if you know the answer, comment below. Thank you.